Voyager Digital, the rise and fall of a crypto lending giant. Imagine entrusting your savings to a company promising not just growth, but safety in one of the most volatile markets on the planet, cryptocurrency. This was the promise of Voyager Digital, a crypto lender that rose rapidly on the back of soaring digital asset prices, only to collapse spectacularly in 2022. Voyager's bankruptcy wasn't just another business failure. It exposed fundamental risks in crypto lending, gaps in regulatory oversight, and the fragility of so-called safe investments in an industry defined by wild swings and complex counterparty risks. So how did Voyager Digital go from promising secure crypto loans to filing for Chapter 11 bankruptcy with debts exceeding $1 billion? And what does this mean for investors, the broader crypto ecosystem, and the lessons buried in the fallout? Voyager Digital emerged in 2018, founded in Toronto, initially as a crypto trading platform. Their business model evolved quickly into crypto lending and brokerage services. Unlike traditional banks, which offer loans backed by tangible assets, Voyager positioned itself as a high-yield platform where retail investors could lend their crypto holdings and earn attractive interest rates, often between 8% and 12% annually, even higher on some stablecoins. To many customers, these returns seemed generous and relatively safe in a market known for huge volatility. At its core, Voyager's model was straightforward. Collect deposits of Bitcoin, Ethereum, USDC, and other tokens from users, then lend this crypto to institutional borrowers demanding liquid capital. The company profited from the spread, charging these borrowers higher interest rates than what they paid depositors. Think of it as a traditional bank's business model, except Voyager did this entirely in crypto, without the government protections or regulatory guardrails banks enjoy. By mid-2021, fueled by a booming cryptocurrency market, Voyager's deposits skyrocketed. According to their SEC filings, the company's assets under management grew from $500 million in early 2021 to over $1.2 billion by year-end. Monthly trading volumes exploded, and their native app boasted over 1 million users by October 2021. This rapid scaling was a classic case of a fintech startup riding the crypto wave. However, beneath the surface of this growth lurked some troubling signs. Voyager's aggressive lending to risky counterparties exposed them to potential default losses. Recall that lending in crypto markets is often opaque. Borrowers do not undergo the same creditworthiness checks or collateral requirements banks usually impose. Instead, crypto lenders rely heavily on collateral valued in cryptocurrencies themselves, which can be highly volatile. Voyager disclosed in late 2021 that it had significant exposure to Three Arrows Capital, 3AC, a Singapore-based crypto hedge fund. 3AC was one of Voyager's largest debtors, with outstanding loans reportedly exceeding $600 million at peak exposure. This concentration risk was a fingerprint of trouble. 3AC had been aggressively leveraged itself, borrowing money to speculate on crypto markets, and when prices started to fall in early 2022, the ripple effects sent shockwaves. Now let's rewind to the broader market context. The early months of 2022 marked a severe downturn in the crypto market. Bitcoin, after reaching an all-time high near $69,000 in November 2021, plunged below $30,000 by June 2022, losing more than 50% of its value. Ethereum and other altcoins followed suit. This bear market squeezed leveraged investors hard, especially hedge funds like 3AC. On June 27, 2022, 3AC missed margin calls, essentially requests from creditors to post more collateral, triggering a cascade of liquidations. This default put Voyager's $650 million loan to 3AC in jeopardy. Voyager immediately recognized this impairment, reporting it in securities filings. However, the hedge fund collapse was just the beginning. In July 2022, a major blow came from the Luna-Terra ecosystem meltdown, which wiped out more than $40 billion in market value within days. While not directly related to Voyager, the broader market panic accelerated withdrawals across crypto platforms, intensifying liquidity pressures everywhere. Voyager, holding illiquid loans and facing mass withdrawal requests, more than $1 billion of customer withdrawals piling up, struggled to maintain liquidity. Customers were increasingly unable to access their funds. The company's leadership assured users that their assets were safe, but behind the scenes, liquidity was drying up. By July 1, 2022, Voyager announced it would halt withdrawals, citing market volatility and extreme conditions that depleted liquidity. Customers watched in disbelief, their assets, meant for earning interest, seemingly trapped in the platform. This decision was a stark violation of trust and marked one of the first clear indicators that Voyager's stability model was unraveling. The company quickly sought external help, entering talks for possible acquisition to avoid bankruptcy. Yet the opaque nature of its loan book and liabilities unnerved potential buyers. Then, on July 5, 2022, Voyager Digital officially filed for Chapter 11 bankruptcy protection in the United States District Court for the Southern District of New York. The company reported liabilities between $1 billion and $10 billion and estimated up to 100,000 creditors affected. This filing was historic, one of the largest crypto bankruptcies by deposits and liabilities amid the 2022 crypto winter. The immediate impact was severe. Customers, many of whom were retail investors, saw their holdings frozen. No simple way out to recover funds. Regulators and courts scrambled to determine the process for returning assets or compensating investors. Meanwhile, the bankruptcy filing revealed serious questions about Voyager's risk management and accounting practices. Digging deeper, Voyager's bankruptcy revealed multiple structural flaws. First, the lack of regulatory oversight. Voyager was not a bank and not insured by traditional bodies like the FDIC. Despite handling billions of customer deposits, it operated largely in a regulatory gray zone. This meant customer funds lacked insurance, unlike traditional savings accounts. Second, the inherent risk in crypto lending. Unlike loans backed by real assets or guaranteed through capital buffers, Voyager's loans were primarily collateralized by volatile crypto tokens. When crypto prices plunged, collateral values collapsed, precipitating defaults. Third, concentration risk. Voyager's outsized exposure to 3AC was a textbook example of poor diversification and risk control. In traditional finance, lenders limit exposure to single counterparties. Voyager failed to do so. Additionally, questions surfaced about corporate governance. Voyager had filed for an IPO in early 2021, but delayed it multiple times, reportedly concerned about market conditions and underlying financial health. Later disclosures indicated the company had started moving customer assets into bankruptcy-protected wallets just before halting withdrawals, hinting at crisis management, but also opacity. Voyager's collapse sent shockwaves through the crypto lending market. Other platforms offering similar services, BlockFi, Celsius, and Celsius's contemporaries, also faced liquidity crises, leading to a broader contagion. The saga reinforced how interconnected and underregulated crypto lending had become. How does this crisis affect you, the individual investor, or broader economy? First, it challenged the narrative that crypto offers safe, high-yield opportunities. The risks are often hidden and complex. Second, retail investors lost confidence in holding funds with unregulated intermediaries. Third, this collapse prompted regulators worldwide, especially in the U.S. Securities and Exchange Commission, SEC, and Commodity Futures Trading Commission, CFTC, to step up scrutiny of crypto lenders, hinting at possible new regulatory frameworks. For example, just weeks after Voyager's bankruptcy, the SEC intensified investigations into crypto lending platforms' disclosures and operations. The New York Attorney General's office also examined whether Voyager and others were participating in securities offerings without proper registration, increasing the regulatory cold front on the industry. Globally, the fall of Voyager and similar lenders added to calls by the Financial Stability Board and IMF for stronger oversight of crypto's shadow banking practices. The IMF's October 2022 report flagged crypto lending and trading platforms as systemically risky due to a lack of transparency, high leverage, and weak risk controls. From a mechanics perspective, Voyager's failure boiled down to liquidity mismatch. Customers' deposits were effectively demand deposits, able to be withdrawn any time. But Voyager lent these out on longer terms to hedge funds and institutional borrowers who struggled to repay or refinance, especially in a bear market. This classic banking model works if asset values and liquidity remain stable, but the wild crypto volatility destroyed that balance. Voyager's experience is a cautionary tale about financial innovation without sufficient safeguards. The company offered attractive interest rates, drawing in millions of users, but relied on unstable counterparties, volatile collateral, and complex financial structures few retail investors fully understood. At the same time, Voyager highlighted the challenges regulators face. Crypto lending blends elements of banking, securities, and commodities markets, defying simple classification. Regulators must balance fostering innovation with protecting consumers and systemic stability. For customers frozen out of their crypto holdings, the bankruptcy process is slow and uncertain. In January 2023, Voyager partially resumed trading on its platform, but with strict limits until the court approves its reorganization plan. Liquidators are assessing user claims, but reports as of mid-2023 estimate recoveries could be fractionary, less than 50% of deposited funds, depending on asset valuations. What lessons can be drawn? First, investors should critically assess where their assets are held. Safety in crypto is not guaranteed by deposit insurance or government oversight. Interest rates above traditional savings rates carry hidden liquidity and counterparty risks. Second, diversification and transparency matter. Platforms exposed to a single or small group of large borrowers are vulnerable if those borrowers fail. Third, regulatory clarity is urgently needed. The fragmented global patchwork of crypto rules leaves institutions and investors exposed. Countries like the US, UK, and Singapore have begun introducing stricter rules on crypto lending, but these measures remain in early stages. Finally, one must remember the broader context. Crypto markets are still nascent and often experimental, with structural weaknesses that traditional finance resolved over decades. That means volatility, failures, and abrupt shocks will likely continue as these markets mature. Voyager Digital's collapse serves as a potent example of how promises of safety and yield in the crypto space can unravel quickly without solid risk management and regulatory frameworks. The mechanics were deceptively simple. Lend customer crypto to risky hedge funds, pay depositors interest from the spread, rely on volatile collateral. But the outcome was systemic. As the industry moves forward, the Voyager story underscores the vital importance of transparency, prudent risk controls, and investor education. Millions of retail investors trusted Voyager, only to find that in the unregulated frontier of crypto lending, that trust alone was no shield against market forces or corporate vulnerability. While Voyager works through bankruptcy and potential restructuring, the broader ecosystem watches closely. Banking on promises of safety in crypto requires understanding the mechanics beneath. At the end of the day, Voyager's saga is a cautionary episode about innovation in finance. Thrilling in the moment, but requiring discipline, oversight, and respect for fundamental economic realities over the long run. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow we are diving into a story that is just as shocking. Credit Suisse, the 167-year-old bank, destroyed by scandal after scandal. You will not want to miss it. I will see you there.